Yes, I can.
Welcome to the webinar. You have entered as an organizer and may now speak to any other organizers or panelists on the line. When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Hi there, a very good evening. I'm just checking onto the sound. Appreciate you all attending the webinar for tonight of FP Markets. I'm just going to be checking the sound if you guys don't mind. If you could kindly type into the box, let me know that you have you can actually hear me, and we'll appreciate that. Let's give it a couple of seconds, and once we've done that, we can proceed with the webinar tonight. As we can see, more people coming into the room, so we'll just give it about a minute or so maximum, and we shall start. Just to get your favor of typing into the box, let me know that you can hear me loud and clear, as well as see my screen. You've got FP Markets logo, and it says webinar. If you can actually just confirm that you can see that clearly, as well as hear my voice clearly as well. Testing 1, 2, 3. Okay, that's great. I think we can start. And firstly and foremost, I would like to say a very good evening to all of you who are attending this webinar by FP Markets. It's FP Markets Risk Management series of webinar. I'll take you through the title of the workshop very soon. Just before we start as well, a little disclaimer. I'll read the first part as well as the last part, and you can always look into the middle part on your own. So we'll just start off with that. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of information as the date of publication. Now, right at the very end here, FP Market, a little information on FP Market itself. FP Markets recommends that you seek independent advice. First Prudential Markets is what FP Market stands for. The FP, First Prudential Markets Private Limited, and it's got its license number right there with SISEC, Australian Financial Services as well, license number 286354, as well as the ABN number right up there with the long stretch of numbers. So that's basically it, and we can then proceed at the moment with the rest of the course tonight. So really glad to meet everyone online here. I'll just give you a little bit, some pointers on FP Markets. Being a broker from Australia, and FP Markets is an ASIC-regulated Australian global CFD Forex provider, serving as a one-stop destination for traders to access a full suite of trading products, including CFDs across equities, Forex, Indices, Commodities, futures, and Bitcoin. Okay, true ECN spreads from 0.0 pips from zero itself, 70 plus tradable products. It's got 24/5 multilingual support, 10 funding currencies, flexible leverage up to 500 to 1, Equinix NY4 data centers, and no recodes. And here, as you can see at the very bottom here, the outstanding 24/5 multilingual service is available to you by FP Markets, and has basically led to FP Markets having the most satisfied clients 5 years running and being awarded with the highest overall client satisfaction award, Investment Trends 2016 Australia's CFD report. So that's a little bit about FP Markets. They've also got 21 liquidity providers with over 10,000 trading instruments as well. So it's a wide range of instruments with a good sort of service, quality services in terms of its spreads through its liquidity providers as well, a range of So there you go, a little bit about FP markets, and I'll be very happy to proceed further with your webinar title at the moment. It's a certification course series of webinars by FP, and just go on. But this time around, you are privileged to actually attend the Mastering the Psychology of Risk Management series. It's part 1 of 4, and the title of that is The Mindset of a Pro Trader. It's a very interesting course. We've got part 1 right up part 4. We've got it running every week basically. So same time next week, and that will be the second one. We'll run up to 4 series, and then after 4 parts, and then you'll be eligible to answer the 20-question quiz, and with a certification coming through as well. Okay, so let's just begin. There are 4 core topics in this part 1, okay, and it carries introduction to neurofinance. You've got brain functionalities versus better decision making, igniting patience and discipline, and then we go on to more of a practical approach, the how do you actually do it, and it's basically bridging the gap between theory and practice. Okay, so I would like you guys to stay tuned and join me in this journey of understanding a little bit more about neurofinance. So we'll go through the introduction side of it, of neurofinance. It's basically a very new topic. It's a lack of research as well, but it's growing in the amount of research that is actually done over the past 2 years. And they have lots of experts out there. Researchers have found the link between understanding the brain as well as financial decision making. So I'm just taking you through the definition side of it, and then we've also we'll go through the 3 parts of the brain that you need to understand how the information gets catered, and also knowing your money personality types, and as well as a trade plan. Okay, so we'll take you through step by step. We'll just start off with the definition, a brief intro to neurofinance, as you can see. We'll just go through that. Now, neurofinance is a relatively new area, as I've mentioned, of research that strives to understand financial decision making by combining insights from psychology and neuroscience with theories of finance. Okay, so that's a very simple sort of definition of what neurofinance is. But we'll take you through in understanding. The first thing that actually strikes me as a trader myself, as well as a mentor, is the mind. Basically, there's no mind without the brain. So we would need to understand a little bit more about the functionalities or the type of the parts of your brain that would actually make all these decisions or help you make these decisions. But to know that, it's probably best to start off with the roots of the decision-making process, which is your brain. So there, the brain, as you can see, versus decision-making has got 3 parts. Now, the 3 parts of your brain consist of the logical, the emotional, as well as the sensation. Now, we know about all the logical part of the brain. I'll take you through the diagram, the illustration to understand that. But the tip, as you can actually see at the very bottom here, is to use all 3 parts of your brain. And why? How do we actually use all 3 parts? Before knowing how, it's probably best for us to take a look at what are the 3 parts of the brain. Okay, so we shall go to this part. Of course, before we go into the 3 parts, before we dissect the brain, it's probably best for us to understand generically there are 2 hemispheres of the brain. So you've got 2 hemispheres of the brain, as you can see. You've got the expression, emotional intelligence side of it, and that's on the right side of the brain. And then you've got the numbers, doing analytical thinking, languages as well. That would be on the left side of the brain. So you've got the logic versus the creativity. So creativity is on the right hemisphere of your brain, and the logical, analytical side of it would actually be on the left side of the brain. So when we actually go into the brain functionality itself, you've actually got 3 parts of the brain. Now, hence the reason we've got that tip earlier on saying that it's probably best for you to use all parts of the brain. But let's just look into all these 3 parts first and understand what they are before we actually know how do we actually get all three parts of the brain involved in trading, making your decisions in trading. Okay, so here, for example, we've got this very simple. This is courtesy of FX Street. They've actually done quite a number of neurosciences related subjects as well in relation to trading, whether it's Forex or stocks, equities, any financial instruments online. We've always got this root of understanding the brain that applies to all financial instruments and trading, even taking risk and everything else. So let's take a look at the very first one. Now, the first part of the brain, as you can see, has got the logic side of it. We need to understand that all logical, organizing things, the everyday, day-to-day life has got this frontal part of the brain. It executes decision with self-control, consciously telling yourself things as well on your day-to-day sort of routine is the logic side of the brain. That's your first part of the brain. That's the logical side of the brain. We've got a logical brain, and that's your first part. Now, we've also got the second part. Now, we'll travel through the second part. Now, this is probably the least talked about part of the brain that relates itself very largely to trading as well. So you've got this emotional brain. Now, as you can see, you've also got all these areas right here, and one of the area that is really important for us to understand as the fear, sort of, that controls the fear, that has actually got the part that where all the emotions, with regards to risk and flight or fear of flight kind of response, actually starts off with this area here, the amygdala. Now, amygdala in Greek is the same word for the almond. And almond itself, I mean, just looking at its size, is actually quite close to the size of the amygdala in your brain. So hence the reason it came from that Greek word. So that's basically consists of this entire area that you see, this 1, 2, the amygdala, the BTA, as well as the hippocampus, are basically the areas that makes out the limbic system. So it controls feelings as well. Let me just get that sorted for you. Sorry about that. And you've got the feelings, impulses, urges as well. Now, in trading, basically, when you are in trading, that probably have got scenarios whereby you've made a trade and perhaps it's not going the direction you're going. Then you've got all these emotional sort of or feelings that comes with the worry of what's going on with your trade, or things like that, and anything that's actually coming in that side of it. If at all, let's say as a scenario, you're actually going into a trade and it has gone against you or against the direction that you've traded, then you've got that emotional response that comes from this side of the brain, and that's basically generated from the emotional side of the brain. So there you go. You've got your logical brain, you've got your emotional brain. And lastly, but not least, you've got the brainstem area. That's your third part. Now, that basically is attached to the neck area, so it has got more sensational type response, giving you sweaty palms, for example, if you've got sweat running down your back of your ears or your neck. And that basically is a response that comes from being triggered at the brainstem area. So hence the reason you've got the logical brain that basically covers all the sort of consciously in your mind kind of thing, where you logically think and put things, rightly organized. And then you've actually got the feeling side of it that comes, and once you're actually in that activity, depending on whether it is, a feeling of greed, uncertainty, fear, and everything else that has got emotions involved, would actually be then considered being controlled by the limbic system side of it, because it involves feelings, impulses, urges, and then it's gone on to connect itself. So all of these three basically connects itself and produces a response or a behavior of a trader. And hence the reason it is important for us to understand that the last part of the brain as well is the reptilian brain. Okay, it does actually connect a lot with your survival, protection, security, various others. So this is basically where it runs down from the neck all throughout the spine and controls the bodily response. So you've got three parts of the brain. Okay, so hope that's clear for all. If you guys have got any questions that you need me to just go back a little bit, rewind, or anything that you would need me to repeat, just let me know. Okay, so that's basically just a brain right there for you to understand. I mean, of course, with regards to trading itself, with regards to risk management, understanding your risk appetite, it's probably best to go back to not only understanding the brain, but it has two elements that would make out a strategic type trader being in control of these emotions as well. And it all boils down to being more patient and disciplined. And how do we actually achieve patience discipline is by first understanding your brain, okay? Because your brain can actually be programmed, and you would actually have got steps, and the method that you are analyzing the market using certain steps basically would then create or help you nurture patience and discipline. So patience and discipline in trading or in any other area of your life is just very impossible to just learn from a book. And it's not something that you can actually learn from a book and read a book and then you would then become more disciplined and patient. The way to actually go about it is to understand firstly, of course, the working of your brain, and it does actually boil down a lot onto the way you are actually trading, analyzing the market. Are they actually step by step? How is it? How does your plan, your trade plan, looks like? So it does actually depend a lot on the methodology, on whether or not you are engaging both hemispheres of the brain and also the three parts that we've actually talked about. Okay, so I'll introduce you a little bit as we go on to the next parts as well, part 2 right up to part 4. You will see that we'll go straight into the practicality of analyzing the market with a trade plan, and within the trade plan would have techniques and activities that you would actually be doing that would then help to engage both hemispheres of the brain, mainly because they're of different nature, whether it's patterns, whether it's little calculation, so various other things that needs to be put all together to help you engage both hemispheres of the brain, especially the three parts of the brain that we've talked about. Okay, so here, for example, there are various studies have actually talked about how would a trader achieve not only discipline and being more patient, but also to achieve consistency. Consistency has got a very big connection with being more patient and disciplined in not only analyzing the market, but also before you actually make that trading decision. Okay, so here, for example, being a strategic trader, a trader that would achieve that patient discipline, would have actually gone through the processes to achieve that, would have these three elements that would make you more patient and disciplined. So it's quite simple. They've got it in the bulleted points, but I want to make it really simple before we go on to the other parts next week onwards, in order for us to practice whatever that we've actually talked about. So I would like to keep that at a 30% theoretical sort of level or ratio versus a 70% practicality onto your charts, onto analyzing the markets, and so on and so forth. So here, for example, it is very essential in being more patient and disciplined to actually adopt a methodology that gives you an idea of the big picture in the market. It is essential for you to understand the big picture, meaning the psychology of the market, what drives the market, whether it's a risk off or a risk on environment. So hence the reason it is, it's quite common for traders to just jump into the chart, for example, and go on to trading, clicking the buy or the sell button, or drawing, some analysis straight onto the chart. But it's also important for us to look into the big picture through news, understanding the sentiments. Sentiments are the feelings of the market. There are generally three very crucial feelings of the market, whether or not the market is on a risk on mode, which actually drives greed, for example, and that's the first emotion, greed. Greed is quite a powerful emotion compared to the fear emotion. The emotion of fear. If a trader is actually fearful, for example, that would an investor would pull out his or her investments and looking into pulling out from risky assets and going into least risky assets like safe havens, for example. And we'll talk a lot more about that when we go on to the next parts, because it would be best to demonstrate to you through the charts, for example, understanding how a risk off and a risk on environment would actually look like practically for you. So it is essential, once we talk about seeing the big picture, it does actually boil down to the trend as well as market sentiments. When we talk about market sentiments, we're talking about the feeling of the market. When we talk about the feeling of the market, we're talking about mass psychology, feelings of whether or not there's got more greed that's been driving market prices upwards. For example, we call it a bullish market. Whether or not market at the moment, if at all you're looking into a sideways type market, that actually means that it's not trading to the upside or downside. It's just literally traveling on a sideways horizontal type movement that would then stretch out to be more an uncertain market. So that uncertain market usually would help you understand that there's just no decisions made as yet, so hence the reason they're moving sideways. They may also be holding on the investments, and traders are actually just waiting. And this could actually be on a realistic market environment. A sideways type market would actually then be driven by the waiting of fundamentals, like data releases, economic data releases. So these are when we've got a sideways type market. So you've got that second emotion, which is uncertainty, driving the market when it's a sideways market. If the market is actually being driven to the upside, skywards, that would most probably be driven by the greed. And if at all you've got a sell-off, let's say, and then you've got all these candles onto your charts just pointing downwards, and you've got them elongated, all these candles traveling downwards towards the floor, then you would be looking at a market that's driven by fear. And when you've got fear driving the market, that's a bearish type market driven by fear to the downside. And the angle of that trend, if it's more towards a 6 o'clock type angle, if you're looking into your watch, for example, you've got a 6 o'clock angle, you've got a 5 o'clock, 4 o'clock. So if it's towards the 6 o'clock angle, just depreciating downwards wildly, let's say, that would then give us the idea of a very bearish market. So that's a big picture that we need to understand. We need to understand whether it's a risk off or a risk on. How do you differentiate these? Is just by knowing whether or not you've got the flow of investment coming out of risky type assets going into less or least risky type assets, or are they actually loads of appetite of risk? If that is it, then it would be risk on market. Risk off is when we switch off the switch of risky assets, and then we would then see the price of gold, probably the price of JPY, Japanese yen, or the CHF, Swiss franc would be actually going up. Then we know that that would be a drive towards less risky assets or safe havens. Then we know that that is a risk off type market. So whether it's a risk off or risk on, that is what we'll be guiding you through in the rest of the other parts, so you can then understand how do you look into the charts and where do you actually go on to in which part of the trade plan to understand the big picture, sentiments and trend as well, whether it's a risk on or risk off. So that's the big picture that we need to understand. Also, what would actually make the ingredient of you becoming more and more patient and disciplined is, if at all, your methodology, or whether it's your style of trading, an approach, or even a trade plan that you have, does it have steps that comes in sequence? This is really important. Now, these steps in sequence, meaning that you've got the first step right up to the second, third, or whatever number of steps that you have, but does it actually entail a complete type approach or process in understanding the market? For example, understanding the market from a big picture point of view that we've mentioned would then needs to be led or leading you towards understanding various other elements like economic calendar, for example, economic data releases, geopolitical events, for example. So these are all on the categorized under the fundamental side of it. Okay, so that fundamental would then need to be married with other elements in within the process of trading successfully. So the process of trading successfully usually consists of the method, of course, and then you've got money or risk management, as well as psychology. Now, psychology itself consists of about 60% of the entire process, and then followed by 30%, which consists of the risk and money management, has got to do with a little calculation of formula and understanding on whether or not you could connect your equity with the time frames, as well as understanding your lot sizing, which is one of the biggest topic that you would need to know in within risk and money management in trading. So once we actually go into that subject in part 2 or part 3, we'll connect more of it practically. You will then understand what sort of lot sizes that you actually need. What are the simple formula that you can actually be using in order to understand the size of your lots when you actually open up a trade? Should you actually open a one lot trade that has $10 per pip, or do you and what does that all mean? What does the pips mean to your lot sizes, and is that a appropriate type of risk that you need to take? So all these basically are areas that we need to sort of put it in sequence, so that you have got a sequence of things to do. What follows what is really important, and in within these steps, if at all, it's actually triggering the right hemisphere versus the left, and it goes back and forth. Probably be engaging your brain hemispheres a lot. So all these activities would go hand in hand in making you really busy in your mind as opposed to your hearts and the emotional side of it, and that would then slow down a little bit on the responses, like your sensational side of the brain. So hence the reason it's really important for us to use all three parts of the brain. And as I've mentioned, if you're looking into the charts, and then you've got a trade plan that you go through the sequence, and these sequence consist of you calculating, understanding what you have read on the fundamental side, and then go back to drawing something or a trend line or a couple of other things onto your charts, then you will see that your whole process of analyzing the market with whatever method or techniques that you have is actually quite a balanced type approach. And that's the third part here that that I've actually put here, which actually is called balancing right with the left brain activity. So if you've got right and left hemispheres, if they're actually kept really busy throughout the whole activities that you do to analyze the market, then you're most probably using all three parts of the brain: the logical, the emotional, as well as the sensational. So all these would then help you be in control once you've actually understood how your brain have actually worked, and understand that the activities that you need to do to actually help you balance up the activities from both hemispheres. I hope that makes sense to you guys, but I would like to just have separate bulleted points for you to understand that patience and discipline would actually come through the process of you analyzing the market. So I'll give you a bit of a scenario. We've actually got quite a number of trainers, gurus out there. You've also got various information about technical analysis, and then you've got strategies and everything else. So let's imagine this. You're new, or you've got a newbie or a beginner in the Forex market, and this trader goes on to learning, let's say, strategies, and just from the very first time actually going into understanding the strategies, and then go onto the chart and start opening the trades. Now, the thing with that is, it looked like that trader may have actually gone through a shortcut to the process that would actually then not fully engage both hemispheres of the brain. So if you've got shortcuts, what would actually happen is that then the logical side of it, as well as the other parts of the brain, may not be fully optimized. And that shortcut would actually cost you lots of risk, basically, because you're exposing yourself to risk or higher level of risk and lower level of probability, only because of the sequence may not be as complete as it could be. Okay, the whole sequence of steps that you do to analyze the market would then make out a trade plan for you. Okay, I hope that makes sense. So that's basically it, just to give you a bit of an idea that patience and discipline, as well as achieving consistency in trading, does actually involve these three: seeing the big picture, understanding trend, market sentiments, and then taking it through a sequence of steps through a trade plan would then actually help you in balancing both hemispheres of the brain, the right and the left. Okay. All right. Now, as I've mentioned as well, the risk off, risk on environment does actually play about a whole cycle or wave of emotions that could easily come into the picture and complete that whole wave there, and would then cause a lot of emotional type responses that would then blur out clarity of the mind of the trader. As we can actually see here, successful traders recognize the point of maximum financial risk. Successful traders also, on the right side, as you can see, recognize the area of maximum opportunities as well. So it is really important for us to seek clarity of the mind in trading by balancing all three parts of the brain, understanding that your trade plan needs to complete a sequence of steps to understand how you can actually analyze the market better to make better financial decision making. Okay, to make your financial decision making better. All right, so there you go. You've got optimism, from optimism to overconfidence, as you can see, and it could actually just go on, like a roller coaster, and then loops up to coming about the same sort of cycle again and again and again. So as long as you are in the trade, so it is really essential for you to understand your emotions, the working of emotions, with your logical side of things, as well as your sensational brain as well. Okay, so here, for example, when I've talked a lot about trade plan and sequence, I mean here at both FP Markets and FX Geometry, we came up with a collaboration to help you as a trader to understand how do you actually put all these pieces of puzzles together to make it a sequential step forward for you to analyze the market. So I've come up with a very simple sort of acronym or an abbreviation for the whole plan. The SOP, as you can see, stands for Standard Operating Procedure. So you can easily see this trade plan as a standard operating procedure. So we always start off with a P, R, I, C, and every letter of the word does actually consist of various techniques and approaches in analyzing the market, making more clarity for you in understanding the sentiments or the trend of the market. Okay, so you've got P, and P does stand for many other P's, like pair, picking the pair, but most important one is the psychology of the market. Okay, so the first step, now we would look into the PRIC as a step that starts off with the first one, P, first step, right up to the second step, which is R. R does actually stand for risk and reward. So understanding, your risk appetite, it's really important for you to also understand your money management side of it through understanding your objective, your goals in terms of the capital that you would like to put into Forex trading, understanding the daily or weekly type returns that you would be expecting. Does it actually marry up with a risk appetite as well, and various others. So we've got various techniques, simple formulas on the R side of it, which stands for the risk reward. Now we've also got I. I stands for insights or market insights, which actually means that, there are various factors out there. Are you as a trader being fed with the right form of information to understand the market, to understand the sentiments, the trend? Does it have any implication on the current geopolitical events, or we've got economic data releases? How big an impact would that actually be? What are the trade decisions made up by policies, by politicians? Will they actually affect the pair for the day? Because in Forex trading, the pair has personalities, and because it's a pair of instruments, a pair of currencies. That basically means it consists of two separate countries, and each country would actually be driven by different factors that would then move their currencies, their respective currencies, to the upside, downside, or even sideways. So you've got three direction of the market as well. So this is basically where market insights from both FX geometry and equity markets will then help a trader understand a little bit more about the market outlook. For example, as you wake up in the morning and ready to actually pick a pair to trade, how are you picking the trade, the pair? How are you actually understanding what's best, or which instrument's best for you to actually pick for the day? And understanding each one currency is also important to know the impact of that currency, the impact from its country towards its currency or its economy or various other factors as well. So the insight would actually be provided by both FX geometry and equity markets, giving you a better insight of the market as well as a market outlook, and to know best pairs to trade and so on and so forth. And then we'll move on to number 4, or step 4. And step 4 consists of confirmation and convergence. Are the things that you've actually pointed out in step 1 right up to step 3, have they actually converged, giving you clarity of the market? If they converge, most likely you've got clarity of the market's direction. You'll understand a little bit more about how, in terms of timing as well, and knowing the stamina of the market's trend as well, whether it will be prolonged for the next couple of days or a couple of months. Is it driven by a single factor, or you've got a collective number of things that are actually prolonging that current trend as well? So converging or confirmation through understanding the correlation between step 1, step 2, and step 3 would then allow you to come up with a confirmation of the trend, the current sentiments, that basically will help you to deal with your step 5 or progress to the last step 5, which is execution of your trade. So basically, in the confirmations or convergence side of it, step 4 will help you decide with more clarity for your financial decision making before you click onto that button, buy or sell, in the 5th step, which is the last step of executing the trade. Okay, so that's your price trade plan, and we'll be in steps to come. We'll basically be looking into going through it practically before we reach the chart and go for the execution side of it. So there are various elements to look at, and I'll just introduce you a little bit as well to the next one. Now, in the preceding area, we're actually went on to knowing the brain right there, and now we're actually just going through it. And once we've done that side of it, it's probably really essential for us in knowing your personality, your money personality. It's actually knowing yourself, your risk appetite as well, knowing the type of trader you could potentially become from some personality traits. And we call it the big 5. Your personality traits could be described as the big 5 right here, from number 1 right up to number 5. So we'll start off with the number 1, emotional stability and emotional sensitivity. Now, it's just very simple. Emotional stability, that's actually ask the question of how calm and collected are you in managing your trades in times of trouble, in times that you're desperate in wanting a better sort of performance on your trade, in the time that it's a live market and you're just in a trade, but then unfortunately it's not going to your direction. I mean, how are you emotionally managing it? The emotional stability versus emotional sensitivity. So emotional sensitivity is when you've got a higher level of anxiety coming in, and you would be responding to that anxiety or fear even in a very different way in the area of emotional stability. So we've got emotional stability versus emotional sensitivity. Now, personality traits of a person, for example, does actually could impact the way you trade, could actually impact your understanding of the market, the clarity of the market, as well as your level of discipline, patience in trading or managing your trades. So hence the reason I'm actually introducing you to the Big Five, and there are ways that we will actually be bringing you throughout the education with us here, both with FX Geometry and FP Markets, to understand the personality traits. Now, personality traits, improving your personality traits through different activities as well, would then give you a better you've got a probability of improving your performance in trading as well. So this is really important. Emotional stability versus sensitivity. Secondly, you've got extraversion or extrovert, being an extrovert versus being an introvert, extraversion versus introversion. What this means in trading terms is sort of quite connected with the third one. Your ability to want to connect to people. It is actually important. At this moment of time, I think in the Forex world as well as other financial markets, especially in the Forex world, it sort of became a social decision in trading. So you've got loads of social decisions. You've got social trading coming up. You've also got people communicating in seminars and workshops and live webinars as well. And you've got groups, communities that are sort of clinging together in a particular type method or techniques or even strategy. And hence the reason it is also quite a good thing to actually practice extroversion as opposed to introversion in Forex trading, especially if you're out there in the world. You mix around with people more, more sociable as well. This could then help you ease your mind's sort of anxiety as well in understanding, also in getting opinion from a group of other traders that are more experienced, for example, in sharing. And hence the reason forums are in the bountiful, and there are lots of forums out there with various topics as well that they specialize in. And it's probably a very good thing to be part of a forum to understand, or also like-minded traders to actually understand, giving you some tips, for example. So, maintaining extraversion is quite an important thing as well, and this does actually boil down to socializing. Because imagine if you are, been successful trading part-time, you may find that this is the life for you, being a full-time trader, let's say. But being a full-time trader does not actually mean that you would need to be right in front of the screen and, all day and 24 hours and not get out at all, meeting anybody, and just concentrate on your trades. Now, that is not a wrong or right sort of thing, but it's actually quite important for us to understand that certain personality traits would actually be really good for us as traders. And as traders, we would be it would be great to have more clarity of mind, and these are the big five personality traits that could be developed, and everybody could develop and improve them to actually to benefit from, in order to increase your performance, your patience, your discipline as well. Okay, so let's just move on to openness and traditionalism. Now, openness and traditionalism in the context of trading does actually consist of whether or not a trader would be very rigid in applying a particular methodology or approach to trading, or even analyzing the market, or would that trader be more open in understanding the performance, understanding that there is still more room to learn and to ask, and to actually learn and enjoy learning much more in improving your style? Or if at all you're just rigid to one, then that would be practicing traditionalism much more, and this could be least beneficial as opposed to being open to more methods, whether it be techniques, understanding. So that basically does come to widening your horizon, being open to knowledge, being open to learning much more. So that's your trait that would actually help you a lot more. Okay, being open as opposed to being really rigid and traditional and adamant to just one and that only. Okay, because it's a moving type world, and a world of forex trading or financial market as a whole is a very dynamic market. It moves, and it may actually create changes as well. So we would need to ride along that change with an open mind. So that's being open. Okay, so agreeableness as well is a fourth one. Agreeableness versus self-interest. Whether or not you're a trader that would like to think about others as well, agreeable to them, or as opposed to just governing your own interests, your own style, and hence all the other traders or anything else out of your bubble would not be of concern to you, and that basically would be self-interest, and it wouldn't be too beneficial in your whole big five sort of development of your trade. So agreeableness does actually come to play, and it is really important to practice and nurture agreeableness. Doesn't actually mean that you need to agree on anything. What that actually means is to look into the outer world and understand that there may actually be give and take between you and other traders, other social, and it'd be good to actually share and benefit from one another as well. And this could easily be joining groups of other traders, especially if you're a beginner, looking into nurturing that whole what do you call that whole learning process. Widening the learning process by joining like-minded people and then looking at a give and take sort of thing would actually encourage agreeableness much more. So that's your fourth one, agreeableness right there versus self-interest. And then we go on to conscientiousness versus impulsiveness. Now this is quite an important one. Last but not least, this actually has got to do with whether or not you're being conscientious, meaning that are you actually having a sequence of things? Are you organizing your thoughts properly? Are you actually pausing? That's the tip that I have right there as well, right at the bottom here, is pausing. I'll talk a little bit about pausing. Before that, let's talk about being impulsiveness versus being conscientious as well. So when you've got a sequence of things I've mentioned earlier on, whether it's a trade plan, you've got a flow of things to organize the information so that it's not overload of information. You organize it in bite-sized type information so that it can actually be absorbed easily for you. Now, whatever that you can actually absorb easily would then encourage you to remember it with your memory, the power of memory. Now, when one is actually learning, whether a trader or anything else or anyone else in various industries are learning, they use the word learning. What actually it is just the ability to remember and have it recorded in your memory much more. So the more bite-sized type information would make you learn much better because it's absorbed much better. So being conscientious would actually then mean to be able to organize information thoroughly, carefully and in bite size, so that you can actually not only remember it but understand it to be succinct type information. So in the trading world, it is really important for us to filter out information. And how do we filter out information? Is when we've got a sequence of steps that we do in order to organize this information, as opposed to being impulsive. So if you lack the conscientiousness of organizing information, go through the trade plan, so on and so forth, then the level of impulsiveness would then be increasing. Okay, so there you go. You've got conscientiousness versus impulsiveness. So these are the big five, and once a trader understands these five, we at FB Market as well as FB Geometry then have the trade plan for you and making you understand a little bit more. So as we go on to part 2 right up to part 4, we will then be visiting these steps more thoroughly and basically applying it practically onto your trading, onto your whole trading process. So a little tip right at the very bottom, if you guys notice, you will see the word pause. Now, in trading, the word pause is actually really, really important, but more than just the word pause, just pausing practically is really important. When you're actually stuck, for example, in making a decision, and really you notice sensations building up to communicate to you that you're feeling more anxious or more panicky or fearful of your entire trading that's going on at the moment. All you would need to do is just pause. Okay, just stop from anything that you're doing. No fingers close to the keyboard to actually click onto the buy or the sell, nothing like that. Just simply breathe and pause. And that itself would then slow down that whole chemical reaction, shoot out of chemicals in your body that would then affect your brain, and so vice versa. And hence, it is really, really important for us to just pause at times. And pausing does not mean you stop breathing or you don't do anything at all. No, it actually could be a sort of distraction as well. Maybe just listen to a bit of music, and that just pause. You could still monitor your trades. Okay, it doesn't mean that you don't care about your trades anymore. It just basically means that you're distracted a little bit, just to buy a little bit more time so that you can concentrate on your breathing instead, as well as something that you enjoy just for that moment. Even a couple of seconds would actually be really, really fruitful for you. Okay, so pausing before you make any impulsive action of trading or doing something that you would regret later on, pausing could actually be really beneficial for you. Okay, all right, we'll move next. Now, this is where we move into the practicality side of things, and all the practicality side of things would be not only explained, but then we would take that practically onto the charts, throughout the trade plan, and understand all these sequential steps. So how do we actually do that? We do that with a very simple price trade plan. Each letter of the word PRIC does actually stand for something. And here I'll just introduce you to the price trade plan just very briefly as we take you through part 2 right up to part 4. We would then be riding along, going through the trade plan in analyzing the market. Okay, so we'll start off with the P. P stands for psychology of the market, but there are many other P's as well. One thing that traders lack doing is understanding what pair they need to actually trade for the day. So pair picking is really, really essential. Understanding which pair for the day it would benefit you much more than being very rigid. So being rigid as well would be against one of the traits, the big five. So hence the reason it is important for us to understand looking at the big picture. So this is where we look at the big picture, understand whether it's a risk off, risk on. We've got various techniques within the letter P itself, with all other words that begins with the letter P, to actually understand that this is what you do in picking the pair and understanding the psychology of the market, the trend, the sentiment. So we've got various tools that would be helping you throughout the first step of the price trade plan, which is the P. Okay. Then we move on to risk and reward. Now it is really essential to understand that your equity does actually connect with the time frame that you're looking at as well. Not many traders would actually understand that. So here in this side of it, it does also relate with lot sizing, picking the right lot sizes. And this is where we would be introducing you to simple formula, and then you connect that with your time frames, understanding how do you actually place the right lot size for your equity, and also understanding how you can actually analyze the market with the right time frame following your equity as well. So we'll be demonstrating this as we go on to part 2 right up to part 4, and we'll take you through the whole process throughout the price trade plan. Then in step 3, under insights, both FX Geometry and FP Markets will be happy to provide you with market outlooks, even webinars to give you an insight to the market or the market's outlook, on understanding what are the trade ideas as well that could actually be beneficial for you in trading for the day. Okay, then we'll take you through in understanding how do you actually come up with high probability, lower risk type trade through convergence to confirmations. Convergence basically does increase either the probability or the risk aspect. So it is important for us to be sure that we're doing the confirmation type process thoroughly as well as accurately. Okay, before we actually reach to step 5, which is executing the trade. All right, so that's basically it. Now, this is how the price trade plan looks like. As you can actually see, you've got sort of like the steps, so we'll take you through step 1 right up to step 5, but each letter of the word has got its own sort of topics, techniques as well, and approaches to understanding and analyzing the market. So with that, basically, we have got a bit of an introduction to understanding what are the elements that we'll be taking you through from part 2 right up to part 4. So I would definitely urge all the attendees to go through with me and to practically apply these skills. And these skills, including geometric patterns and various others, will actually be sipping into each one step, or will take it one step at a time throughout this whole trade. Okay, so with that, before I end the session tonight of part 1, I would like to also invite you to part 2, but also to open up the floor, this webinar floor, with questions. So if any one of you have got any questions, feel free to type into the box. We'll be able to address them and take it through with lots of clarity as well to the second part of the course, okay, which is next week, same time. So I'll just give a couple of minutes more if you guys have got any questions before we end the session tonight, okay? And to see you in our next part 2 session next week, okay? All right, so I guess there are no questions at this moment of time, which is good. It's equally good to collect them as well and bring it to step 2. So with that, I would like to thank you all for attending today's webinar. For any questions at all, feel free with regards to the platform, trading platform of FP products, services. Do email support@fpmarkets.com for any questions that you may have, any queries that you may have about the platform, about the products or services. And once again, I would like to say a big thank you to you all for attending tonight's webinar, and I would be very happy to welcome you to the next webinar, which would be part 2 of this whole series of webinar. Okay, so it comes under the risk management webinar series, and the second part would actually go into more practicality as well. So with that, once more, very good evening. Have a lovely evening, good night as well, and thank you very, very much. Bye bye.